we would like to pay tribute to Charlie Munger, co-founder and partner of legendary investor Warren Buffett. After glorious 99 years, Charlie Munger probably left so that he can advise God on how to manage heaven's investment. He has built a tremendous track record and, more importantly, influenced so many people in their investment journey. Coming to global economy, all central bankers have raised interest rates to multi-year high as they were facing problems of inflation. In order to control inflation, they all have raised interest rates. Today, there are few exceptions which have started cutting interest rates, like Turkey, like Japan. But rest of the central bankers are holding on to their decisions to cut interest rates till such time they get confirmation that inflation is firmly under control. Slowly and steadily, inflation have started easing. As interest rates went up, it resulted into huge losses for central banks' portfolio. They were holding so many of government securities at lower coupon. Now, mark-to-market losses and their portfolio is running into billions of dollars. And this phenomena is universal. चाहे बैंक ऑफ जापान हो, स्वीडन हो, स्विस नेशनल बैंक हो, यूएस फेड हो, सारे के सारी बैलेंस शीट रेड हो चुकी है. Next slide, please. There are few central bankers which have started cutting interest rates. They are far and few, but hopefully this will become a trend over a period of time. One major factor which has happened in global market, well, Chinese FDI has turned negative for the first time since 1998. No one knows what will be the direction going forward. I hope and pray that investors having suffered in China will start looking to India. Coming to US economy, US Fed has raised interest rates at the fastest pace in their history. And now they have started taking away liquidity. Almost more than $1 trillion liquidity has been taken by US Fed in last 1.5 years. Fed has maintained a delicate balance between growth and inflation. If we look at US third quarter GDP growth, it came at the fastest pace in last 2 years, with more than market's expectation crossing 5%. Next slide, please. This second quarter GDP growth also gave confidence to market in soft landing theory. US recession probability has declined significantly after the second quarter result. This growth is not a surprise because it is supported by large fiscal deficit. While the US, IMF and World Bank has advised rest of the world to follow path of fiscal prudence, their own fiscal deficit is at an unreasonably high level. At the beginning of this year, they were looking at a deficit of $1 trillion. By the end of the year, it is almost double at $2 trillion. The fiscal deficit of US is almost in high single digit, and that is a cause of concern not only for US but also for rest of the world. The US debt continues to remain at record-breaking $33.84 trillion. It is up more than $2.5 trillion since debt ceiling limit was relaxed just 6 months ago. US debt is growing by day and by night, by leaps and bounds. US Fed is sitting on a almost $1.3 trillion unrealized loss on their portfolio of mortgage-backed securities and US Treasury. US interest payment now is exceeding their defense spending and has become the largest part of their budget. Almost out of $4 trillion of revenue, $1 trillion is going in payment of interest. The rising interest rates by US Fed has started impacting economy in different ways. For example, the home sales data is worst since 1970. Real estate is one large part of American economy, and that undoubtedly has gone into slow lane. Next slide, please. The job openings, after remaining strong for a long period of time, except briefly during COVID, have now started slowing down. It is not yet full-scale retrenchment or high unemployment, but compared to the past, slowly and steadily, unemployment is rising. As interest rates went up, leverage companies suffered, and US bankruptcy filing is higher than COVID time of 2020. This is also reflected in US stock market. The S&P 500, excluding top 7 stocks like Microsoft, Apple, Google, is now at near COVID lows. That means from rest of the 493 components of S&P 500, they are available almost at same level as during COVID crisis. Now, what will Fed do? They have raised interest rates, they have taken out liquidity. Will they keep rates higher for longer? Normally, we have seen rate goes up by escalator gradually in a calibrated manner, step by step. But when they have to come down, they come by elevator, they fall sharply. Will US Fed prove this again? That while going up, it is an escalator, while coming down, it is an elevator. The worry for Fed will be inflation. Unlike India, where monetary and fiscal policy is working in tandem, their monetary and fiscal policy is at the opposite end. US fiscal deficit remains high, and that puts pressure on US Fed. They certainly would not like a repeat of 1966 to 1983 inflation scenario, which surprisingly looks almost same from 2013 till today. They would really like inflation from here to go down rather than bounce back like in the past. Another interesting thing from a stock market point of view, after interest rates have peaked, the stock market takes time to correct. The correction does not necessarily begin right at the top of the interest rate cycle, but it happens little bit after interest rates have peaked out. Will we see repeat of history this time, that US stock market gives a correction after interest rates have peaked out? What will be interest for us? Well, will money start flowing out of US and back into emerging markets? The emerging markets relative to US looks very, very cheaper over last many decades. Indian economy continues to be an oasis in the desert. This emerging market tracker shows that composite score of India is way ahead of its peers and almost sometimes 1.5 times to 3 times better than peers. Truly, India is an oasis in the desert. The headlines continue to remain positive with an above expectation second quarter GDP growth, with manufacturing PMI remaining in expansionary zone and inflation falling. Almost all headlines for the month of November were positive for India. GDP growth came upwards of 7% when rest of the world was expecting 6%. RBI governor did mention that second quarter GDP will surprise on the upside, but the number came significantly higher than expectation. Next slide, please. 2023 will see India's transition from becoming coach to the global growth train to become an engine of global growth. Now, our growth rate will determine on an incremental basis what happens to the global growth rate. Our activity level continues to remain strong and substantially above pre-COVID level. Capacity utilization has now reached above long-term average, and both of this bodes well for our market. The PMI continues to remain in expansionary zone, which bodes well for the future for manufacturing as well as services. The GST collection remains upwards of 1.5 lakh crore on a consistent basis. The consumer sentiment, after remaining stagnant for a while in post-COVID phase, have started improving. Clearly, this is the most weakest part of Indian economy, which is showing signs of revival. The rural recovery, which was one of the reasons why consumption was slowing down, thanks to reasonably recovered monsoon, has started becoming positive. This Diwali season, consumer durable and consumer staple sales does indicate that rural economy seems to be getting back its mojo. The central and state governments are spending on infrastructure which was built before 2013. Almost similar level of infrastructure is being built between 2014 to 2024. Central and state governments are the torchbearer of infrastructure spending, and they are taking the lead to support private investment. If we look at manufacturing, mining, services projects, they all seems to have started inching up over their historical average. And project under implementation, both private and public, is showing upswing, which means capex cycle in India has already started improving. One of the big reasons why Indian growth slowed down was when real estate activity as a percentage of GDP started declining. That seems to have bottomed out in post-COVID phase. And now residential unit sales are reaching near record highs. Real estate has started contributing from mid-single digit to high single digit to GDP and should cross double digit over a period of time. Real estate sales are hitting all-time highs, and that's contributing to the economic growth. Credit growth continues to fund the expansion. Both industrial credit and personal credit has been growing at reasonable pace, supporting sustenance of growth. As luck would have it, even crude prices have declined by about 5% in recent times to touch $75, despite Saudi and Russia announcing production cuts. Clearly, God seems to be Indian upstairs, which has lowered crude oil prices against backdrop of Russia-Ukraine war, Israel-Hamas war, and production cuts led by Saudi. This shows that oil prices are likely to remain subdued for some amount of time. One of the concerns for Indian economy is negative growth in hiring in IT industry. Large companies are letting people go and not replacing them as they are not seeing their order book grow significantly. IT sector was providing employment, high quality employment to people, and slowdown over there could have consequences for consumption. The other thing which was worrying Indian economy was freebies culture. There are many states whose fiscal deficit as a percentage of GDP is fairly high. And instead of spending money for creating infrastructure, they are spending on providing freebies to the individuals, to the citizens. This is unsustainable. Fortunately, the state election results indicate that people are not buying freebies. People want jobs, development, and growth. Coming to equity market, well, Nifty results have been fantastic. Most of the returns on sales, EBITDA, PBT, or PAT level were above expectations. Very few companies disappointed on sales or PBT level. The India Inc. financials continue to remain good. Net profit is growing at a reasonable pace. Revenue growth is subdued, but margins continue to expand. Clearly, this is a Goldilocks scenario where despite low revenue growth, low volume growth, margins have expanded. I hope going forward, volume growth comes back and companies share benefits of lower raw material cost with consumers. The EPS growth of Nifty 50 or Nifty 500 continues to remain reasonably strong in double digit. Across the board, we are seeing benefits of cost cuts and volume growth resulting into margin expansion. We are looking at roughly about 1,000 rupee EPS per share for FY24 and about 761 rupee EPS for NSE 500 for FY24. Valuation wise, large caps are almost near historical average. Mid caps are at a marginal premium to their historical average and also at a premium to large cap average. Small caps have also started trading at a premium to its historical average. Clearly, mid and small continue to trade at a premium to their historical average, making them look richer on valuation. Market capitalization to GDP ratio has crossed into triple digits and it is above historical average of 80% of GDP in the last decade or so. The FPI holding in Indian equity is at a 10-year low at just around 16.5%. It is almost equal weight to India as India's weight in MSCI emerging market reaches somewhere around similar level. We believe there will be limited selling pressure from FPIs in the days to come, as they wouldn't really like to underweight a country like India. Recently, FPIs have turned buyers, and after selling in September and October, in November, they have become buyers of almost $1 billion worth of equity. The same trend should continue in December, and we will see in the next year, post-January, FPI investments picking up as new allocations are made. One big thank to mutual fund distributors is participation of retail investors in mutual funds and equity market. That has resulted into India's equity risk premium falling from 1.3, 1.4 times emerging market peers to roughly about 0.6 times emerging market peers. As our risk premium has gone down, return expectations will come down and P ratio will expand. We also have a reasonable amount of domestic cushion to absorb FPI selling. Cash, cash in equity fund is roughly about 90,000 crores. Balance advantage fund and asset allocation fund can increase their equity allocation in market becomes cheaper. That number in our estimate is roughly about 65,000 crore for correction. EPF allocation in a year could be upwards of 40,000 crore. And SIP at the last month's run rate will bring about 2 lakh crore into market over a period of time. Essentially, we are looking at buying support of about 4 lakh crore if there is a correction in the market over next 1 year. More importantly, arbitrage fund size is now almost 1,45,000 crore. They fund speculators by going long futures market. And this also gives ability for HNIs and family offices to absorb FPI selling. Our outlook continues to remain same for a while. Neutral weight to equity, marginal overweight large cap, equal weight mid cap, and marginal underweight small and mid cap. This call may look little bit early with the benefit of hindsight on small and mid cap, but who knows how to time the market to perfection. Better to be safe than sorry in money making. The reason why we are underweight small cap is their relative valuation gap vis-a-vis large and mid. Normally, small cap trades at a reasonable discount to large cap. This time, small caps are trading at a premium to large cap. Within the market cap, a large portion was almost 83% large cap in 2003. Today, scales have tilted in favor of small and mid cap compared to large cap, contributing to overall market cap. And hence, looking at all these factors, our recommendation is to be marginally underweight small cap, marginally overweight large cap, with equal allocation to equity. This slide you are quite familiar with. US Fed's pivot, election 24, energy prices, consumption recovery, they are all factors which will impact the market. If those events move in favor of the market, markets will rise. Otherwise, it may see a correction. Election is round the corner in May 2024. We thought, let us present some data around election. In 9 election cycles since 1980, only 3 times market has delivered negative return, where if we look at 6 months before election or 3 months before election. In fact, it looks like before election, it is the best time to invest. If we look at election cycle return over government tenure, generally in the second and third year, we see maximum negative return for investors in the second and third year term of the government. In last 9 election cycle, there were 4 years in both second and third year of the new government where markets gave negative return. If we look at sectorally, power, banking, and IT are probably better bet for playing pre-election cycle. Those sectors have delivered positive return over last 6 months, over 6 months before election. In terms of equity investment, we continue to recommend SIP or STP with a longer term horizon. On a rolling return basis, across most of our equity fund, we have added value to the customer by outperforming benchmark indices. The same is true for our hybrid sets of fund and tax fund. Over period, we have outperformed benchmark indices and added value on a rolling return basis. On a point-to-point basis, there are few funds like midcap where on a 3-year basis, we have not outperformed benchmark indices. On a 1-year basis, this range is higher, but we have gone through this in the past. In 2017, one IT company became part of the index. We evaluated that company every time during an epic bull run where it moved from being 1% of index to 4% of index. Every time we found the stock expensive and we stayed away. Today, the stock is down about 70-80% from that prices. Clearly, we have to be very, very clear in picking up right quality stocks rather than focusing upon short-term outperformance of benchmark indices. Despite limitations across most of our equity funds, we continue to outperform benchmark indices over 3, 5, 7, and 10 years. The same is true in our hybrid funds. And if we look at SIP, across most of our funds, we have added value to our investors by generating better return than benchmark index. The same is true in our hybrid funds and tax plan. If we look at Kotak Flexi Cap Fund, it went through a tough period in last 4-5 years. But now the turnaround has happened by keeping portfolio tuned for the future development. On a 2-year as well as 1-year basis, fund has started outperforming benchmark indices despite its large size. Kotak Multi-Cap Fund was our NFO. It has Triveni Sangam of large, mid and small. And this fund also has delivered better return to investors by outperforming benchmark indices. Our Harfan Mola fund remains Kotak Equity Opportunities, which gives blend of large and mid-cap stocks. And over the years, it has consistently outperformed benchmark indices to give you enhanced return, additional value. Kotak EQ Contra Fund is something which is whose performance has been noticed by distributors and investors. Essentially, Contra Fund is investing into universe which is hatke to normal equity stocks. We try to invest in underperform sectors. We try to buy stocks below their long-term average valuations. We try to buy stocks which are trading at a sharp discount to industry leaders. We also look at trading below 200-day moving average. And while trying to identify these companies, we don't let go our basic fundamentals of investing, which is long-term growth potential and management. By combining this, we have kind of sailed against the wind and delivered fantastic alpha over last 1, 3, 5, 7, and since inception. Kotak EQ Contra Fund is an ideal fund for investors who want to invest in a hatke companies or hatke sectors. This requires longer term investment horizon because there's no guarantee that once we identify a contra stock, it is likely to run. It may take some time before it delivers return. Our equity NFO track record continues to remain decent, except for Kotak Global Innovation Fund, where the NAV is still below par after almost 3 years. Really, we mistimed in launching this fund. We failed to anticipate China crackdown on technology. We failed to anticipate US Fed fighting inflation so aggressively. And we failed to anticipate that innovation cycle has become more competitive. This fund has failed to meet investors' expectation. And bearing that, all our NFOs in last couple of years have added value and created value for investors. Coming to debt market, we had one of the biggest rally in US bond market since 1980. There was almost across the board gain as US 10-year yield started coming down from just around 5% towards 4.2, 4.3%. Inflation showed sign of easing, and that resulted into hopes that US Fed will start looking to cut rates. US Fed is now not committing to the market when will they cut interest rates, but market is expecting that somewhere around mid 2024, Fed should be looking to cut rates. US yield curve has eased off in recent times after the inflation data. Indian bond market has also started seeing index inclusion bond flows. A lot of FPIs have started looking at India to invest into its debt market. Liquidity, which was in deficit for a while, thanks to the government tax collection, has now become marginally positive, which bodes well for lowering interest cost. With higher liquidity, overnight rates also have softened. The inflation number came within RBI's target range and little lower than market expectation. That again gives confidence to the market that after US Fed starts cutting rate, we will also see rate cut in India. RBI will wait for Fed to move and then take their call. The debt market continues to look attractive from a duration point of view. We will recommend all investors to consider dynamic bond fund, gilt fund, bond fund to add duration to your fixed income portfolio. Like equity, these are the factors which are going to influence interest rate movement. Currency, the mystery buyer, most probably Russian central bank buying Indian gilt, and policy changes in both US Fed as well as RBI is likely to cast shadow on how interest rates move. Coming to the debt market, as I mentioned, dynamic bond fund continues to add value to the customer. And this is something which can be looked in a range bound with downward sloping interest rate market. Our Harfanmola fund continues to remain the hybrid funds. They go up with the pace of a rabbit and come down with the pace of a tortoise. In our Kotak equity saving schemes, the allocation to equity is about 10 to 50%. Average equity over last 7 odd years is about 29%. Upside downside ratio is 41 versus 13, almost 3 times. Balance advantage fund, which now has almost 3-year plus record, average equity allocation 43%, but upside downside ratio is about 2. That means to go up, this fund goes like rabbit, and to come down, this fund comes like tortoise. These are ideal fund for doing systematic withdrawal plan to get regular income. These are ideal fund for a conservative investors who doesn't want to take too much of volatility, too much of a risk. These are essentially the fund which provides 5-star service at Udupi hotels rate. Every HNI will have private bankers chasing them. But for retail investor, professional fund managers will do the asset allocation between debt, equity, and in some funds into gold as well to to deliver asset allocation solution to customers. Kotak Debt Hybrid Fund has about 25% allocation to equity, rest is into fixed income. And look at the return, high, uh, high single digit, low double digit return across various time periods since inception, and mid single digit alpha for investors. Kotak Equity Savings Fund is a chota balance advantage fund kind of fund. It goes 10 to 50% in equity, in line with balance advantage fund allocation. And that also has delivered high single digit return and a large outperformance to benchmark index over a period of time. Coming to gold, in March 20, we gave a buy call on gold, saying that there's so much of liquidity in post-COVID era that gold prices will benefit. We continued with the same call in 2021, which didn't work out. It delivered negative 6% return, but we maintained our positive stance on gold. And we feel today vindicated that between 2022 and 23, gold has delivered better return. While recommending gold, we had mentioned that gold is likely to give better return than fixed income. Despite setback in 2021, we have seen gold delivering better return than fixed income since March 20, when we gave buy call on gold. We told investors and distributors and our partners, sovereign gold bond is the best bet for a long-term investment in gold. Other than that, you can look at gold ETFs. The reason why we are bullish on gold is that it has consistently built a base to reach all-time high level. This is primarily driven by central bank buying led from China, Singapore, and so on and so forth. Western central bankers are probably selling gold, and Eastern central bankers are buying gold. This has resulted into gold prices getting supported. If we look at gold cycle, whenever interest rates have come down in US, gold prices have been supported. As per most market analysts, Fed should be looking to cut rates in mid 2024, and that should be supportive for gold prices. Silver is also keeping pace with gold as demand has started increasing for silver in various industries like automobiles, solar PV cell, and urbanization and infrastructure. The demand supply equation for silver is also supporting higher price for silver, just like the gold.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.